It's inevitable that from time to time, a home buyer will walk into your real estate office and proclaim they want to buy a home. But in that same breath, they'll ask you, as their real estate agent, how to pay for it. Of course, agents are not responsible and rarely should give advice about the financial aspect of the transaction. However, today's home buyer will often rely on their agent's direction and influence. It goes without saying, then, that agents should understand the value in the financial arena surrounding loans. While there are various loan programs available, at the heart of the options is the conventional loan. As its name implies, this is the basic loan format, the most commonly used option, and one of the many vehicles your homebuyer will have available to him or her during the buying process. Before getting into the details of these loans, it is important to understand the experience your homebuyers have at this point. Many homebuyers will come to real estate agents after hearing about fantastic loan programs, discount options, and super low-priced interest rates. And, sometimes, homebuyers will want their agent to explain it all. It is important to remember that you should recommend your clients to a financial expert who can provide them with the proper advice when it comes to their mortgage and financing. However, you will have to be knowledgeable enough to be able to explain the main concepts and what they stand for. For that point, view conventional loans as the starting point. Depending on various scenarios, a homebuyer may qualify for other forms of financing, such as an FHA or VA loan. More on those in another lesson. However, it's impossible not to explain what conventional loans are without talking about the opposite version. FHA and VA loans are government-backed loans. A homebuyer may apply for a loan and receive financial backing from a government agency, reducing risk to the lender. Conventional loans do not have this type of financial backing. For the purpose of this lesson, our goal is to break down the conventional loan structure. So, what are conventional loans? These are financial loans given by banks and other financial institutions to borrowers for the purchase of a home. Conventional loans are neither issued nor guaranteed by any federal agency or the government. Should the borrower default, unlike other types of loan offers, these loans present no promise to the lender for financial help. As a result of this, lenders will require stricter financial requirements. Now, home lenders set their own terms. Some are more willing to offer lower prices or fewer requirements for a down payment. Generally speaking, most conventional loan lenders hedge the risk of having no government backing by requiring a 20% down payment on the home purchase. Additionally, borrowers must also pay for private mortgage insurance, commonly called PMI. There are very strict guidelines in place for conventional loan lending. These are established by the Federal National Mortgage Association, Fannie Mae, as well as the Federal Home Loan Mortgage Corporation, Freddie Mac. These loans are available to most people applying for a home loan. However, unlike government-backed loans, they are harder to qualify for because of more stringent qualification requirements. Without any type of federal backing, conventional loans are a higher risk to lenders. For that reason, they often require a higher credit score for home buyers. They also will need to demonstrate they have a steady income. Also, it is important for home buyers to have a down payment they can afford. Considering these factors, the loans are not always for everyone. How can a home buyer obtain a conventional loan? Generally, any mortgage lender will offer conventional loans. A home buyer will need to demonstrate their ability to meet the requirements of these loans. When a home buyer meets with his or her lender, the mortgage agent will work with them to determine if they qualify for this loan, and if not, what other potential loan programs may be available to meet their needs. This is often done after an initial application is accepted by the lender from the borrower. In nearly all cases, you can simply instruct your home buyers to apply for a loan through their preferred home loan lender. Then, the lender will process the application and present the buyer with options that fit their credit qualifications. If they do not qualify for a conventional loan, the lender may present other options. This is generally done within a matter of hours to a day or so. As an agent, you'll want to make sure your home buyers have completed this prior to looking for homes to purchase. You can use this information to determine how much of a home they can afford. Why would a home buyer want to use a conventional loan? There are advantages to conventional loans. First, in some cases, conventional loans can be more affordable from the viewpoint of a home seller. With FHA loans and other government-backed loan programs, the federal agency will place restrictions on what the homeowner can buy. For example, a home will need to pass safety inspections and a lead screening. Lead equals toxic poisoning. These requirements can slow down the home purchase process. Secondly, conventional home loan borrowers have to have a much larger down payment. They are generally well-qualified buyers. From the seller's viewpoint, they are more likely to purchase the property. For this reason, home buyers should view conventional loans as a good investment and even a negotiating tool. Conventional loan interest rates can be just as good as FHA or other government-backed loans for the right buyer. However, home buyers will want to examine all options prior to investing. Now, let's talk about another factor that can play a role in the availability of a conventional loan and the process of obtaining them. It's the loan-to-value ratio, or LTV. The loan-to-value ratio is an important tool for lenders to consider when assessing the amount of risk a borrower presents to the lender. It is always used when determining if a lender should provide a loan for the purchase of a home or any type of real estate. This is done before the mortgage approval is processed. In short, the more expensive the home, the more risk the lender has to manage. As its name implies, this is a calculation of how much risk is present when considering the amount of the loan requested compared to the value of the home. When there is a high LTV, that means there is more risk to the lender than a lower LTV. LTV is important for several reasons. Most importantly, If a lender feels the LTV is too high, the lender will require the borrower to obtain mortgage insurance. This somewhat helps reduce the risk. But before getting into private mortgage insurance, let's talk more about the calculation of LTV. It is possible to find a number of LTV calculators online. These are okay for the average home buyer to use and get an idea of what the LTV will be on any home they purchase. Lenders will base LTV on the appraised value of the home or the sale price of the home, whichever of the two is less. To calculate the LTV, you have to take the loan amount and divide it by the sale price or appraised value. Here's an example of what this looks like. Let's say a home buyer wants to purchase a home that is appraised at $100,000. The home buyer will provide a $20,000 down payment, which means he is borrowing $80,000. The LTV is then $80,000 divided by $100,000, or 80% in this case. This information is very important to the lender. The person working with the home buyer, often a mortgage agent, has to present the loan to the underwriters. The underwriters of the loan will then determine if there is too much risk to provide this person with a loan. When this value is higher, there is less likelihood of that approval taking place. Conventional loans require 20% down payment to reduce the LTV. However, even after that 20%, some home buyers may still be too much of a risk through this loan opportunity, and the underwriter may decide the loan is too risky. Fannie Mae and Freddie Mac currently have a 97% LTV on mortgages. This means that, in some cases, a homeowner can qualify for the loan with just a 3% down payment. This type of acceptance is often only available to those who have a very high credit score. Additionally, it is important to recognize that borrowers who do not have high credit scores may be better served with a government-backed loan, such as an FHA loan. Now, how does private mortgage insurance work? Private mortgage insurance, or PMI, is often a requirement for all conventional loans because of the high risk involved in these loans. PMI is a type of insurance product that protects the lender, not the home buyer. It works by providing the mortgage lender with reimbursement up to a certain level for the home loan if the home buyer defaults on the loan. This type of insurance only pays the lender if and when the home itself is not worth enough to pay the lender for the total amount lost, if the home must go through the foreclosure process. PMI is nearly always a requirement whenever a homebuyer purchases a home with less than 20% down payment. It may also be required when the homebuyer is obtaining a conventional loan because of the lack of security the lender has when the home loan is not a federally backed loan. Now, home buyers may cringe at the need to pay PMI. In fact, many times the home buyers do not know what this is, how it works, or why they have to pay it. As an agent, you may receive questions about PMI, because it is always spelled out thoroughly in the closing documents and the loan documents that your homebuyer will have at the time of being approved for a home loan purchase. Another important factor to consider is the length of time the PMI is required for. Most of the time, homebuyers will not have to maintain PMI long term. It can be canceled down the road after the homebuyer has proven that they will make their mortgage payments on time. How and when the lender will agree to the reduction and elimination of the PMI requirement depends on the lender's requirements and their decision about the borrower's qualifications. In the meantime, homebuyers should expect to pay, in addition to their home loan payment, between 0.5% and 1% of the mortgage loan. This is paid to a servicing company each month. In nearly all cases, the lender will establish that the loan payment and the PMI payment will be collected at the same time. The borrower does not pay PMI directly to the servicing company, but rather to the lender each month. How should you approach conventional loan questions from your home buyers? Conventional loans remain a staple in the financial tools available to home buyers. Are they the best option for every home buyer? No, that's not at all the case. Rather, conventional loans are often best for those who may not otherwise qualify for government-backed loans and those with very good credit scores and qualifications. They also should have a 20% down payment available to qualify for the lower LTV that Freddie Mac and Fannie Mae allow. It's also important to know that loan requirements and conditions will change over time as policy changes. As a real estate agent, you may not be able to provide financial advice to your home buyer, but you should be able to explain to them what the different options are, as well as what they should do to obtain the loan they are looking for. And of course, you also want to make sure your borrower has a loan in place before moving forward with the home search.